sana.
Okay, a big...
Now, Equity Bank Group Holdings has reported a 14% rise in the first half pre-tax profit to 35.2 billion shillings. Now, sustained growth in customer deposits as well as economic rebounds pushed the lender profits to 26.4 billion shillings. 8% growth compared to the same period last year, while customer deposits grew 21% to 1.18 trillion shillings. But with fluctuations in interest rates, the lender now projects a slow loan uptake in the second half of the years. Now, Jimmy Mbogo was there and joins us with more. Good afternoon, Jimmy. What else is there from the Equity Center?
Well, indeed, a very good afternoon to you too, Nyakundi. Yes, of course, this is the half-year earnings by Equity Bank, and I will be taking you through some of those numbers. But a key thing that have been mentioned here is the fact that now the bank is projecting that the DRC subsidiary is going to overtake the Kenyan subsidiary by the year 2027. And also, the projection that is quite interesting for you, for viewers, is the fact that the company now is projecting that going forward by 2030, the insurance business will probably have overtaken the banking business. And of course, I'll be giving you more details in terms of what has been happening. But of course, the big conversation within the banking sector and the banking industry at large is the question of interest rate. And I'm here with Dr. James Mwangi, who's the group MD. Dr. Thank you so much for making time to speak to us. So one of the things that we really want you to help us understand, we are seeing that loan loss provision has increased significantly by almost over 80%. So maybe help us understand what is happening in that space. And are you foreseeing a scenario where there are going to be a lot of defaults?
We are experiencing and are going very difficult global microeconomic environment. We see, for instance, inflation globally is almost at 10%. That has forced central banks and governments to increase interest rates significantly. In the U.S., interest rates have been increased from 0.25 to 5.5. Here in Kenya, we have seen the central bank increase its interest rates from 7% to 11.5. So essentially, that is being done to manage and to tame inflation so that the cost of living can be managed. But unfortunately, the burden is being taken to the borrowers. If you look in Kenya, the government is now offering 16 and 17% for 3-year bonds. And the government is now competing with the banks. So banks are offering similar interest rates to retain the deposit. As a result, that cost is being passed to the borrowers. And we have seen lately that interest rates are now averaging 18%, making it difficult. We recognize that high interest rates means increased risk of default. And as a prudent bank, then using IFRS 9 regulations, we are recognizing that potential default in managing the bank and making provisions for it. And that explains why our provisions are at 89% this year. To recognize that and not to bury our head in sand. Times are difficult, default is imminent, and we need to be cautious how we declare profits. We only declare profits when we have made requisite provisions.
All right, so Dr. I know that there has been a lot of volatility within that interest space, and the question then that we have is how has it impacted in terms of your borrowing, your lending activities so far when you look at the first half of the year?
Volatility, particularly in the macro environment, that is interest rate, exchange rate, and inflation, has adversely affected everybody. If you look, our interest expense is growing at 54%, and our interest income is only growing at 27%. So when people see us increasing rates, we're not increasing rates to grow profits, we're increasing rates to pass over the cost of depositors to the borrowers. That instability is likely to hold for some time because inflation has stubbornly refused to come down despite the high interest rates that central banks all over the world has raised.
All right, so how has this fluctuation within that interest rate space affected the loan book?
Interest rates fluctuation has affected the loan book in two perspectives. The one is the risk of default, and that is where we have seen provisions being made to mitigate that risk. And the second one is decline in borrowing. We see, for instance, in mature markets like Kenya, the uptake of loans has declined significantly because of the high cost of borrowing.
All right, so Dr. let's talk about something that we have seen in the news, which is the fact that we are seeing smaller banks basically struggling with their capital adequacy. So from where you sit at Equity Bank, are you considering any mergers or any acquisitions in the near future?
It is true the times are difficult. We are seeing that the high interest rates are resulting in declining profits, and some of the banks going into losses, which have to be offset against capital. But looking at the central bank reports, looks like the Kenyan banking industry is very well capitalized, and the central bank has come out and pronounced itself that it will support the banking industry in terms of liquidity. We at Equity seems to be very lucky that our capital buffers are quite high. They are on the basis of 600 basis points. Our capital to total asset, weighted asset ratio is at 20, and that enables us to have 600 basis points difference. And that provides us with ability to stabilize the banking industry and support banks like we supported Spar Bank when it was necessary to protect depositors' money.
All right, now from the performance that you have just announced, of course, we are seeing a lot of improvement from the subsidiaries. And so what then does this say about the Kenyan banking market?
One, it says that the Kenyan economy is growing as, or is industrializing using the financial sector. It is more of a service economy. It's becoming dominant. If you look at the contribution of growth of our economy, the financial sector, the services sector generally has become the driver of the economy. We have become the dominant financial systems in the entire region, which is again suggests the maturity of the Kenya financial system and the strength that the Kenyan economy has in having the entire region.
All right, thank you so much, Dr. And of course, Nyakundi, there you have it. We'll be giving you more details, particularly just looking at those numbers and how they look and trying to make sense of those numbers. But for now, back to you.
All right, thank you so much, Jimmy, for that. Now, the Departmental Committee on Communication, Information,